Japan, for decades, it was the envy of the world. Technological and industrial titan that rose from the ashes of World War II to challenge America for global economic supremacy. But for the last 40 years, Japan has been trapped in a cycle of debt, deflation, and demographic decline. And just when it seemed things couldn't get more challenging, a trade war launched by its closest ally. The United States has pushed this economic giant to a historic breaking point. Recently, the Japanese government approved a multi-billion-dollar stimulus package. On the surface, it's a $6.3 billion shot in the arm for businesses and families reeling from American tariffs. But in reality, this is just a band-aid. It's a temporary fix for a wound that was opened decades ago and has refused to heal. To understand why Japan is in this precarious position and how it's being forced to radically rethink its place in the world, we need to go back in time. We need to go back to the deal that broke one of the world's most dynamic economy. In the early 1980s, Japan was an unstoppable force. Companies like Toyota, Sony, and Panasonic dominated global markets. The Made in Japan label was a symbol of quality and innovation. Many in the West, particularly in the United States, watched with a mix of admiration and fear, believing Japan was on a trajectory to overtake the U.S. economy. This success, however, came with a consequence: a massive trade surplus with the United States. At the same time, the U.S. dollar was incredibly strong, making American exports expensive and imports cheap. To solve this, the finance ministers of the 5 largest economies, the G5, met at the Plaza Hotel in New York on September 22, 1985. The result was the Plaza Accord, an agreement to intentionally devalue the U.S. dollar against the Japanese yen and the German Deutschmark, and it worked almost too well. In just 2 years, the dollar lost nearly half its value against the yen. For Japan, this currency shock should have made its exports more expensive and cooled the economy. But in a fateful decision, the Bank of Japan reacted by aggressively cutting interest rates and pumping money into the system to prevent a recession. This flood of cheap money had to go somewhere. It poured into the stock market and real estate, creating one of the largest financial bubbles in human history. The numbers were staggering. At the peak in 1989, the land underneath the Imperial Palace in Tokyo was estimated to be worth more than all the real estate in California. The Nikkei stock index soared to nearly 39,000. It felt like the party would never end. But all bubbles burst. Fearing runaway inflation, the Bank of Japan slammed on the brakes, hiking interest rates sharply in 1989 and 1990. The effect was cataclysmic. The stock market collapsed, wiping out trillions of dollars in value. The real estate market followed, with property values plummeting by over 70% in the following years. This wasn't just a market correction, it was the beginning of an economic ice age. The lost decade had begun. A decade that would soon turn into 2, and then 3. The crash left Japanese banks with mountains of bad debt. Businesses and families were bankrupt. The economy ground to a halt. The government's response was to try and spend its way out. They've launched dozens of fiscal stimulus packages since 1992. At the same time, the Bank of Japan did the only thing it knew how to do. It cut interest rates. Again and again and again, until they hit zero in the late 1990s. This is where Japan fell into what economists call a liquidity trap. A liquidity trap is a nightmare scenario where monetary policy becomes powerless. Even with interest rates at zero, the economy doesn't respond. Consumers don't spend because, with falling prices, a phenomenon called deflation. They believe things will be cheaper tomorrow. Businesses don't invest because they see no demand. Cash is king, and everyone holds on to it. Desperate, the Bank of Japan ventured into uncharted territory with radical policies. First, quantitative easing or QE, where the central bank prints money to buy government bonds and other assets. Then, something even more extreme: yield curve control, or YCC. With YCC, the Bank of Japan doesn't just control short-term rates. It actively buys massive quantities of 10-year government bonds to force down long-term borrowing costs, trying to entice companies to invest for the future. The result of these decades: a national debt that has ballooned to over 260% of its GDP, by far the highest in the developed world. The Bank of Japan itself has become the country's largest creditor, owning over half of all government debt. It is, in effect, financing its own government to date. And despite all this, growth has remained stubbornly low, and wages have been stagnant for a generation. But Japan's economic woes are intertwined with an even deeper, slower-moving crisis: its own people. Japan is the oldest society in the world. Almost a third of the population is over the age of 65. This is the result of two converging trends: one of the world's longest life expectancies and a chronically low birth rate. For decades, Japan's demanding work culture has left little room for family life. And young people have been having fewer children. The economic consequences are profound. An aging population saves more and spends less, which further dampens domestic consumption. With a shrinking workforce, the country's growth potential diminishes year after year. There simply aren't enough workers or consumers to power the economy. This isn't a problem that a stimulus check or an interest rate cut can solve. It's a demographic time bomb that has already detonated. It's caught in this 40-year storm of internal problems. Japan has always relied on one constant: its alliance with the United States. Since World War II, Japan has been a cornerstone of American policy in Asia, a loyal partner in trade and security. In economic terms, it has been a state of near total dependence. But the Trump administration's trade war shattered this post-war understanding. The tariffs, particularly on the all-important automotive sector, which accounts for a huge portion of Japan's GDP, were seen not just as an economic blow, but as a betrayal. The uncertainty created by the administration's unpredictable policies paralyzed Japanese businesses, which thrive on stability. This external shock, however, is having a revolutionary and unintended consequence. It's forcing Japan to do the unthinkable: break free from its dependence on the United States. For the first time in generations, Japan is actively and urgently seeking to build a new economic bloc in Asia. This has led to a stunning diplomatic thaw with its historical archrivals, China and South Korea. Wounds from Japan's imperial past run deep, but the existential threat of a global trade war and an unreliable America is proving to be a powerful motivator. Leaders from the three nations have been meeting, discussing everything from trade pacts to supply chain cooperation. Japan is realizing that its future may lie not across the Pacific, but with its immediate neighbors. It is a tectonic shift in the geopolitical landscape, born from the chaos of the trade war. This brings us back to today. The recent stimulus package is a stopgap, a way to shield a population already burdened by decades of stagnant wages from the immediate impact of tariffs. The situation remains mired in uncertainty. A recent ruling by the U.S. Court of International Trade declared that the president cannot impose these broad tariffs without consulting Congress, throwing the entire strategy into legal chaos. But this only adds another layer of unpredictability. Businesses and governments are left in limbo, unable to plan for a future where the rules can change with a single tweet or court decision. Japan stands at a profound crossroads. It is caught in a perfect storm: the lingering ghost of the 1985 Plaza Accord, the mathematical trap of its debt and deflation, the unstoppable force of its demographic decline, and now a geopolitical shockwave from its greatest ally. The actions of the United States, in their perceived arrogance, have inadvertently forced Japan to finally confront its own stagnation and its place in the world. The old model is broken. Dependence on America is no longer a given. The question is, what comes next? Can this crisis be the catalyst for Japan to finally reinvent itself? To forge a new economic and political identity, independent of the West? Or will the weight of its history, debt, and demographics prove too much to overcome? The land of the rising sun is facing its longest shadow in modern history, and the path it chooses to walk will not only define its own future, but also can reshape the balance of power for the entire world. And don't forget, like the video and subscribe the channel to keep thinking the world how it really is.